A loan can look completely safe on paper, while the collateral itself actually creates a deep hidden risk. India's banking system currently occupies a position of strength. According to the June 2026 Financial Stability Report, gross non-performing assets stood at just 1.8%. Credit growth accelerated to 14.5%, and bank profitability remains supported by stable margins. But beneath those headlines, gold-backed loans have more than doubled year on year. Since 2024, they have grown at a compounded annual rate of 42.4%, nearly twice the pace of other non-housing retail loans. Outstanding gold-backed debt now exceeds $54 billion. It is currently the largest segment within the nation's non-housing retail lending market. This divergence between overall banking health and the explosive growth in a single asset class is why a familiar collateralized product is suddenly receiving intense regulatory attention. Borrowing against jewelry is a generational practice in India, providing households with a way to convert stored wealth into emergency liquidity. The move into formal bank branches has shifted the economic nature of this borrowing, turning traditional emergency liquidity into a mass-market retail product. This institutional scale means the safety of the banking system is now linked to how loan growth, household stress, and gold prices move in sync. High market prices have transformed these household assets into an active mechanism, fueling a broader collateral cycle across the banking system. To the borrower, the transaction is simple. It converts a family asset into immediate cash, without the need for complex income documentation or long credit histories. For lenders, gold creates a high-yield retail asset with short tenors and physical collateral that is relatively easy to value and liquidate. This safety is measured by the loan-to-value, or LTV, ratio. If a borrower pledges gold worth 100,000 rupees and receives 75,000, the LTV is 75%. That remaining 25% is the lender's cushion. It is the vital margin meant to cover principal, interest, and the costs of auctioning the gold if the borrower fails to repay. A secured loan is only as safe as this gap. If the margin between the loan amount and the collateral's market value vanishes, the protection disappears. When gold prices rise, lenders see a larger buffer, and branches see an opportunity for easier growth. Borrowers use that increased collateral value to take out larger loans or top up existing ones, a cycle that can delay the moment when their actual repayment capacity is tested. By September 2025, Indian household debt reached 45.5% of GDP. RBI data indicates that a dominant share of this borrowing is used for consumption purposes. While productive borrowing can create its own source of future income, consumption borrowing solves today's cash flow gap without creating a way to repay the debt tomorrow. Rising asset prices hide weak borrower cash flow, substituting true repayment capacity with a mathematical cushion that only exists as long as the market holds. The risk is heightened in bullet repayment structures, where the principal and all capitalized interest come due at the very end of the loan. Because no payments are made, the outstanding debt creeps upward over time, steadily eroding the 25% cushion the lender started with. If this inflated debt reaches maturity during a price correction, the jewelry's market value may not cover the total amount owed. In this scenario, price volatility transforms a secure retail product into a source of systemic loss. Recognizing these risks early, the Reserve Bank of India moved to tighten regulations before visible defaults could destabilize the sector. The new framework introduced standardized purity checks, end-use monitoring, and strict limits on top-up loans, targeting the specific points where collateral lending often fails. To balance access with safety, the RBI implemented tiered LTV limits, allowing higher leverage for small emergency loans while requiring more conservative margins for larger exposures. These rules attempt to separate the product's value as a liquidity tool from its potential to become an unmanageable channel for household leverage. The current data shows the system is manageable, household net financial savings have improved, and bank stress tests remain within safe bounds. However, a healthy loan book is characterized by repayment from a borrower's income, while a risky one relies on the recovery strength of an auction. If a loan depends on gold prices staying at record highs to remain safe, the entire system's stability rests on continued market confidence. When the safety of a loan is tied entirely to a rising valuation, the physical gold in the vault is less important than the belief that the price will never fall.